Happy Friday, everyone. Welcome back to Markets for Millennials for the weekly market analysis from August 22nd to 26th. And we started off down. We started off with a bad day, and we ended the week on a bad day. And what a bad day it was! You can just see that candle on the S&P 500, and it's just pretty crazy the selling that happened. Obviously, the big news event of the week that happened today was the Jackson Hole Symposium, and you had multiple Fed speakers speaking today, but obviously the notable one was Powell, Chairman Jerome Powell, speaking at Jackson Hole, and his speech really ended up. The price action today was really interesting for a number of reasons, but in the end, as the market continued to digest what Powell said, it became very clear that the market didn't like it. It seems pretty clear that the market thinks that Powell was more hawkish than expected, and and this kind of comes on the heels of, really after a while where we had Fed speakers coming out and pushing back against this rate cut narrative that was happening. I don't have it up. I should maybe sometime I'll have that chart up for a video, or maybe I'll put it in my newsletter. But if you look at the implied federal funds rate based on the Eurodollar curve, then the markets had been pricing in a whole rate cut up until a few weeks ago, and then over the last, I think, week and a half, you're seeing that start to price out. And this was a big thing that some people were watching for, to hear Powell really talk about how the federal funds rate was going to have to stay elevated for a much longer period than anticipated, and that the market pricing in rate cuts in 2023 was something that they were going to have to also be pushing back on. And so there's a slew of economic data, and then that I want to talk about, as well as Chair Powell's speech. And then we'll look at the charts after that. So I just wanted to pull up a few things, because actually, let me go back to the S&P chart for a second, because obviously on Monday we had a large down day in the markets, a little bit of continuation from the selling on Friday last week. And so on Monday, right off in the morning, we had the Chicago Fed National Activity Index, which actually showed a positive number, which was higher than expected and higher than previous. And so that was really interesting. A lot of there has been for a long time a lot of anxiety over the potential for recession. Obviously, people screaming at the GDP report that was released previously, and all that storm made about the redefining of recession. In reality, the numbers continue to show that we are not in recession, but we are actually in something more like Goldilocks, which shout out to Darius Dale and 42 Macro for really pointing that out for the last few weeks. You should give them a follow, and follow the Macro Minute on YouTube if you have the chance. A lot of good info there. Just wanted to plug that for them, because they've definitely been helpful for me. And obviously, Goldilocks is what you learn is that Goldilocks is a situation where you actually have growth increasing, but you have inflation decreasing, and so that's the situation that we had post-COVID, post-March lows in COVID for a time. We went through obviously bouts of Goldilocks and then reflation and things like that. But in any case, a lot of when you have a situation where the market, the labor market is hot, where you have growth not really slowing as much as what has been expected, but then inflation was falling based on the July inflation data that we received earlier this month. That's indicative of the Goldilocks kind of paradigm. And so the Chicago Fed National Activity Index was another data point to show that. Kind of some mixed data, though, that came on Tuesday with some manufacturing and service PMIs, which both came in below forecast, but the services PMI, you can see it on the screen where I just highlighted it, the 44.1, was way lower than expected, and also lower than the previous number. And so the markets when you go back to the S&P chart, the markets weren't really sure what to make of that. We had a down day, but it actually, there was a lot of intraday volatility during that day. And then also new home sales, which were markedly down, not only from forecast, but also from the previous reading. And then we had some orders, and then the pending home sales index. And these were also below previous, or I'm sorry, the orders were below previous and below expectation. But then the pending home sales, while below forecast, were higher than the previous. So that was very interesting. And so the markets started to rebound on Wednesday and on Thursday. And what was interesting was here I have on the FRED database, I have the initial jobless claims. And the initial jobless claims had come off the previous week. I had talked about this on Twitter, in my newsletter, and I believe I might have even hit this in my video last week, but we came off. A lot of people were talking about how because this number had been slowly increasing so far in 2022, since it bottomed in March and April, that there was going to be a point where the non-farm payrolls was going to show a slowing of job creation and perhaps even losses of jobs. And then obviously that number last week was actually a catalyst for some selling, selling off last week, which was kind of interesting, at least some volatility, we'll say it that way. And then so on Thursday morning, the jobs report came in with higher initial claims, and I believe also higher continuing claims. I don't have that chart up on the screen. And so the markets, again, when you look at yesterday's candle, you saw some intraday volatility early in the day, but then the buying just continued throughout the day. And it sounded like what was going on was the market was continuing to buy back into this idea that the labor market was coming off. And I think that people have been watching the labor market because one of the things that the Fed has been able to continue to cite as an issue was the continuing hot labor market, and that's something I will show you in Powell's speech that he mentions as being something that is still a sign that the economy has some room for more tightening. And so when this number came up higher in this last month, it's kind of hard to see that it's up, but you can see that little notch up. But as it came higher on Thursday, people are starting to return back to the idea that, well, the labor market will slow down, and that will be something that will lead eventually to this Fed pivot. And so what we've been seeing in the markets, ever since ultimately, back in June in July we got the June CPI report, which was obviously the 9.1 or 9.5 something like that percent. Year-over-year CPI, and a lot of people said that's the bottom, or I'm sorry, not that's the bottom, that's peak inflation. And then we had the July 27 FOMC meeting, which was interpreted as being very dovish. On August 10th, the CPI came in lower, and there's been a lot of coverage about the rate of change of inflation coming off so substantially. In that CPI report, especially pertaining to median and sticky CPI. And then the markets continued up, and the market essentially had been, until having this pullback recently, has been anticipating just continuing to be data dependent, and there wasn't really, other than Jackson Hole today, a whole lot of opportunity for the Fed to do anything, or to at least telegraph what they're doing. Their next policy meeting isn't until late September. And so we were going to be data dependent, waiting for the next CPI report in September regarding August as the clue for, maybe will Powell have the opportunity to take his foot off the brake a little bit of the economy. And one of the things that I feel like the markets kind of forgot about today was the PCE report, which came out this morning, Friday morning. And I thought this is kind of interesting. So you have PCE month over month coming down by 0.1%. And then but then the core PCE was actually up. And so the reason why you see that, because PCE is it's personal consumption expenditure, so it's what are consumers actually spending. And the reason why this is the case is if you go, for example, if we just use oil as the proxy, it's because in the entire month of July, oil was coming off after having come off for essentially most of the month of June after hitting a yearly high on the 14th of June. And so we have a couple months of declining oil prices and a lot of declining commodity prices, which brought down the headline PCE number month over month and year over year down to 6.3, where previously it was 6.8. But then when you remove that decline, you actually had core PCE go up 0.1. And year over year, we're still at 4.6. And I just want to point out that 4.6 number right there, the Fed wants that to be 2.5. When the Fed says that the neutral rate is 2.5, what they're saying is that they believe in the long run this PCE number, this PCE, core PCE number, year over year is going to be at 2. It needs to be at 2 or 2.5, somewhere in that range, for a federal fund rate of 2.5 to be neutral, a neutral policy rate. And so I thought it was really interesting if we just, let me go back to the S&P 500 and let me put a 1-minute chart up. Let me turn the drawings off for a second. Because the PCE data got released. Let me see here. Yeah, the PCE data got released at 5:30. So we had an immediate, quick little spike. You can see as we followed the price action, we had this little spike, sold off, and then just boom, and this is a 1-minute chart, but you started to see this appreciation that took place in price. And if you go from the base to the top, 0.68% in about 24 minutes. So the market was really liking the PCE numbers. And what was interesting is, to me, 4.6, okay, it's down. Core PCE, I should say. It's down year over year by a little bit. PCE, we've had a couple of 6.3 prints of PCE going back to April and May. It's down from last month, but not nearly that much. That the PCE was at, down 0.1 month over month. Okay, yeah, a decline. And what was interesting, I was scratching my head about this because when I look at this information, I'm just giving you my opinion. I'm not obviously an expert, but given what the Fed is telling us, when I look at these numbers, I don't see anything that says that the Fed can pivot anytime soon. I just don't see it. The rate of change isn't enough to me, and I honestly, I know that some people disagree, but I was a little surprised that the rate of change wasn't even lower, or wasn't even more to the downside, just given the CPI numbers that we got earlier this month. So I was honestly expecting both of these to be 0 or below 0 on the month over month. And I was looking for PCE to be 6 or a little bit less than 6, and then core to be closer to 4.0, not closer to 5.0. And so I think that's. I looked at this and I said, well, that's not a good thing. That to me doesn't suggest room for the Fed to pivot. And yet, again, when you look at that chart, the market was taking it very nicely. Right, and then it started to give it a little bit back, and I'm not really sure why. But then, right at 7, Powell began to speak, and we'll get into that in just a second. Price initially reacted. You can see in approximately 3 minutes worth of time, we had dropped a considerable amount, and then Powell didn't really even speak for that long. And then once he finished speaking, the market came right back up, and then. And I think right here is kind of funny. I saw in Zero Hedge, there was a tweet from Zero Hedge right as this was happening in the market that Zero Hedge was saying that the market was done with its little overreaction move to the downside from the speech. And then, well, the rest is history. This is what took place the rest of the day, right? So I mean, we're down. If you look on the side, the S&P was down over almost 160 points, the NASDAQ almost 600 points, the Dow a little over 1,100 points, the Russell about a little over 74 points. Just some pretty crazy price action. So what was it that catalyzed this? Why is the market selling off here? Was it Powell? I mean, like, if you think about it, over the last couple of weeks, or over the last week or so, we've had a lot of Fed speakers come out and kind of telegraphing, that people need to hold their horses on this expectation of a rate cut and any sort of pivot. What I thought was interesting is early in Powell's speech, he said this. He said, restoring price stability will take some time and requires our using our tools forcefully. So there was a big thing made about the use of the word forcefully to bring demand and supply into better balance. And then he mentions while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean a far greater pain. And this is when you started to see the market starting to dip a lot lower at a considerable higher rate. We went down over 100 points on the NASDAQ, I think, during this, right after this was said. And so then he went into talking about the strength of the labor market and it being out of balance because there's too much demand for workers and not enough supply of workers. So that was something that he mentioned. So again, they're looking very, very closely at the labor market as one of their key criteria. And then they mentioned the July inflation. This was I thought a much bigger deal. They said while lower inflation readings for July are welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. And so that was something I think that was a little bit of a shock because everyone got really excited that after everybody called peak inflation on the June report, which came out in July, and then the July report showed that inflation had come off. People got really, really excited, and the Fed basically said, well, that's not enough for us. We need to see more than that. And then I also thought this was really interesting, and I kind of thought there was something left to be desired after the July FOMC meeting. I shared about this, where they talked about raising the federal funds rate, and this was where their estimate, keyword estimate, I highlighted this, of where the federal funds rate is projected to settle in the longer run. But then he made a point to say currently estimates of a longer run neutral rate are not a place to stop or pause. So this is basically saying, well, we may be at our long-term vision of neutral, but that's not where we have to stop in this particular case. And that's something that I was beating on the table for a little while. And so he mentioned being data dependent. And that it might be appropriate to slow the pace of increases. I think this was that issue that got the market a little bit excited at the beginning, right after the presser ended. I think when we saw this bounce right here, I think when we saw that was about the spot where the markets were thinking about this idea that that as the data came in, monetary policy would be appropriate, or it would be appropriate to slow the pace of increases. But they talked about maintaining restrictive policy for some time, historical record cautions against prematurely loosening policy, the median federal funds rate running slightly before 4% through the end of 2023. So this was the key about where they were basically kicking the narrative about rate cuts in the face, essentially. And then he gets into this issue about lessons, okay? And so it was the third lesson that I think was a really important issue. We must keep at it until the job is done. Okay, history shows that the employment costs of bringing down inflation are likely to increase with delay as high inflation becomes more entrenched in wage and price setting. And so talked about a lengthy period of very restrictive monetary policy back in the 70s was ultimately needed. And it makes a comparison until the spring of last year. And they said our aim is to avoid that outcome by acting with resolve now. And then they used the word forceful and rapid steps to moderate demand and it says we will keep at it until we are confident the job is done. So that's the whole speech. It was actually a very, very short speech. And once it was over, there was, like I said, there was that bounce and then a little bit of sideways, and then we basically sold the whole day. So to me, this was not expected. To me, when I've been saying this for a long time, or for a couple weeks now, I'm part of the group that believes that the market got too excited about the possibility of a pause in rate hikes, and not just a pause, but I think even the market was, because the Euro-dollar futures curve was suggesting this, that the market was looking forward to 2023 rate cuts. And so the market was starting to price all of that stuff in ahead of time very optimistically. And so I think that, the only reason that you're seeing price action like this, so obviously let's get some things clear. Powell didn't crash the market. The market over-expected or had wrongful expectations. And I would say maybe the market wasn't data dependent. I mean, that would be maybe the way that I would frame it. Because again, like I look at the PCE, I don't see anything suggesting that the pace of decline in PCE or core PCE is going to come in line with expectations anytime soon. I mean, again, if you think about the difference between the June and July number on core PCE year over year, and you think about how we only dropped 0.2 percentage points when we saw such a sharp decline in sticky and median CPI and trimmed mean CPI. I don't think I mentioned that earlier. With such a huge drop, to me, I was expecting more as far as a drop from this PCE. So if we can have that substantial a drop in CPI and it doesn't show up in the PCE quite as much, then I think it's going to take a long time for this to come down to even 3 or 2.5%. And so I just think that the market wasn't, I don't think that the market was really thinking about all of that. The market has been excitedly pricing in, Goldilocks. The market has been excitedly expecting, the Fed to pivot, and it just hasn't happened. And it's not going to happen for some time. And I know that we would say, the pivot is actually when they pause. But we'll see what happens. But I think the market was also pricing in rate cuts for next year. And so the market was starting to front run that. And I think that that's got to get priced out of the market. Because unless something crazy happens, unless like an actual recession happens and we see substantial declines in employment, in labor force and stuff like that, and unless we see substantial declines in, inflation data, like which only really typically comes in recession, it's nothing's going to happen. They're not going to pivot. It's not going to happen anytime soon. So, having said all of that, I've already gone on. It's a little over 20 minutes. Let's take a quick look at the charts. A lot of technical damage. I was watching, so I had, once we got rejected here, so let me put up my moving average. Once we got rejected off the 200-day moving average, which came at the confluence of this trend line resistance, I had this horizontal resistance right here, this red line, which I thought might hold. We didn't hold, but then we popped above it. It turns out that the most important level was these yellow boxes, right? And I still think this bottom yellow box could definitely come into the picture here. You can kind of see that where things are starting to line up. I'm gonna say that I don't believe that revisiting the lows is a guarantee. I'm actually wondering if we're gonna catch support right there, and if we're actually gonna make a higher low and then resume up and then make a higher high from here. I'm not saying we will. I'm just wondering if that's a possibility. And I think I expect that more than anything. If you notice here, this yellow box, the reason I use the yellow box is because support and resistance isn't always just a hard, straight, thin line. Sometimes it's a region, and this region proved to be an area of support/resistance. And you can actually see we came and we bounced off of it before selling off, and we actually sold totally below it, just broke clean through it. And so what'll be interesting is do we get follow through immediately to the downside, and do we get into this box? And then what happens when we hit that line? Now I added this as soon as we broke. I had something like a wedge, and it broke. And as soon as that broke, I drew this lower line. And so I think that's the line to watch, which again is lining up exactly perfectly with this kind of support level. You can see it was support back here in May, and then resistance in June and in July, and then support in late July after it came above. So you got to watch this spot. This is the spot to watch right here. This is the line in the sand. So on the NASDAQ, the poor NASDAQ. So the NASDAQ came back down below this trend line. I kept this because I knew price was going to come back down. And what I wanted to know is when price came down, would it successfully hold and then make a higher high? And then it turns out that this horizontal resistance, much like I had on the S&P and on my other charts, became the key support, which we did bounce off of and popped back above the trend line. So I was getting ready to delete this, but I just left it just because. And then we obviously sold down below that. And I kind of did a couple of different trend lines. Let me turn the magnet back on. This was the first trend line that I had, which I started using 2 days ago, or 3 days ago, I'm sorry, because it looks like it works out here, and it's not really negated in any way over here on this rise. So we've broken below. Then I just moved it to this today when I was watching price come off. And then obviously we've closed below that. So now I'm going to maybe stick that here, and it'll have the same features as my S&P chart. So I'm going to watch what happens when we get to that spot right there on the NASDAQ. That's going to be the line in the sand. And then on the Dow, we're kind of looking at the same thing. I don't have a trend line here. I'm not really watching the Dow quite as much. We're closing basically right at that support line. So this is a spot where the Dow needs to hold. And if it breaks through here, then I will be looking for it to catch on horizontal support around 31,247. So that's the line in the sand on the Dow. And on the Russell broke its overhead resistance, and so it's got a lot more to go to try to come down and retest this trend line that it broke back in July. But currently, the Russell's a little hard. The spots that I'm going to be watching for, you can kind of see, got a little bit of light support from the in the region of around 1850. So we're going to draw a line right about there. And then below that, it gets a little murky. We'll be watching the trend line to see if that holds as support and we get a resumption off. Just given kind of what I've said about the other indices, then I actually suspect the most likely option. Let me just do this really quick. The most likely outcome, let's see here, is probably this. And so somewhere, so maybe this line is not exactly right. Maybe it should be just a general area right there, where I'm going to expect to potentially see some support either from the horizontal level or perhaps from the trend line support. And we'll see what happens if price gets down there. But the equity indices had fairly severe breakdowns. The momentum is all gone. If I put up my SAMS indicator, we got phase transitions to neutral in every single one of the equity indices. You can just kind of see as they pop up. You see that little yellow strip at the end there. That's not a good sign. So that's a really big deal. Also, definitely people calling double top up here. And I actually started to wonder myself, but here we are once again closing above this level. I do want to mention that I tweeted about this previously, I think last week or perhaps earlier this week, that my expectation at this level is for price to kind of consolidate around this level before eventually taking off. I still have a bullish bias. The SAMS indicator is bullish. We're hitting the top of the vol range, but we're not overbought like we were back on the 11th of July and on the 14th of July. And so I think we need some sideways action to collect some strength before moving back up again. Like I said, my bias is bullish to the upside. Looking at the treasury yields, Once we got this breakout, remember we got a breakout from this trend line, approximately so. And once we got that breakout, it's been back to the upside. And it's pretty interesting. It's pretty crazy to think that we are, we're actually closer to making a higher high than we are to making a lower low. It's just some pretty crazy price action. Yields are kind of in this like approximately around 3% level, which was a big line in the sand for a lot of people. And I just want to remind everybody that so many people were looking for that head and shoulders kind of thing, and we've nullified that. And I just want to also mention that my thesis has been that we would get one more really good kick up in the yields. I don't know if we'll make higher highs. I wouldn't be surprised if we did, but I'm looking for one more like move up before we eventually top out and then come back down. That's just my opinion. That's what I'm looking for on yields. And then I think once you see the yields come off again, I think that that's going to be the time to buy bonds. I'm not currently invested, so that's something. Let me go, before I go to Bitcoin, let me really quickly go into gold. Had a good bounce on gold, but it started to come off. Maybe it was a sign of things to come. Interestingly, if I pull up my SAMS indicator, we got a quick flash of green, of bullish for a second. So we phase transitioned. The beginning of the week, we had been in the phase transition back into bearish that started last Friday and Thursday, and then shifted back into neutral, and then got into bullish. And so what that means is that either the strength or the momentum is conflicting with the other. So either strength is the underlying strength is very good and the momentum is not there, or the underlying momentum is strong and the strength is not there. Whatever the case may be, when you're seeing this back and forth, red, yellow, green, it means that it's a really, really volatile, conflicting signal. And so I think that that's something to notice. But anyway, in any case, I was nervous about what would happen when we got to this horizontal level. Closed below it, bounced back above, and then closed below it again. If it just doesn't look good. If we don't get above this descending trend line, then I think we're going to make lower lows. I think we'll take out the 2021 lows. But I mean, anything could happen. And then oil. This is something everybody needs to watch. Oil made a higher high than August 11th. And so what I'm looking to see is, are we going to get this kind of rounding bottom, just like we did right here back during this period of time? I think the macro backdrop for oil is still bullish oil. So I have a bullish bias, and I'm positioned to take advantage of what I think is going to be a move back to near the highs. And I think we're going to get there before the end of the year. That's just my opinion. But I'm positioned to take advantage of it nonetheless, whether it happens this year or if it happens into 2023. But I think the prospects for oil are very good. I don't think it's a surprise that if you just see kind of the dotted line that's crossing where my crosshairs are, if you come all the way back over, let me just mark it so you guys can see it a lot more clearly. I don't think it's a coincidence that that oil came down really close to this bounce. So where we bounced up here back in October of 2021, when we found support kind of around that spot. And I'm trying to remember where my trend line is. I feel like I have a trend line. Yeah, it's this trend line. We have this confluence that's kind of coming. I actually thought we would touch the trend line, but we didn't. So we'll see if we do end up coming back down. But in any case, this could be the turn in oil. And that's something people should be worried about, because if oil comes back up, then the food and energy component of the inflation indices will also come up. And actually, I want to do, let me just see if I can do this really quick. Agriculture. The Invesco Agriculture Fund has actually been making a series of higher lows and some higher highs off of its low. And so I think that that's something pretty important. And then also, let's see, metals. Let me see if I can get this up really quick. Let's see. I'm trying to remember if it's industrial metals. Sorry, I'm trying to do this in real time. Let's do this one. Industrial metals are coming up off their bottom and have been coming up for a little bit. So, I mean, those are all reasons why we have to be careful. And I think that energy is going to be definitely something to watch in the long run. And now finally, Bitcoin. Just an ugly, ugly chart. All right. I just want to say a couple things. I've been watching, some of you guys know I was watching something that resembled more of like a flag. So it was kind of something more like this, which then as I saw how price was behaving over the last few weeks, I turned it into a rising wedge. Now I just want to point out too, in a rising wedge pattern, when it breaks, usually price very quickly gets to a particular spot, a particular level. This is really good learning for anybody who's interested in how to trade chart patterns. But you see how I connected these two red wicks to make the bottom of this ascending wedge. And then what's interesting is then if you look at where price came down to just on this one day, it got within a couple $100 on Bitcoin of the spot where the wick, where the lines connect the wicks together, and that's pretty standard in a rising wedge pattern. And so it wasn't surprising to me to see after this waterfall that price was going sideways for a little bit, and then obviously today we had we're still for about an hour now from now Bitcoin's daily candle will close, so still a lot of time for something to change or for it to come off more, but in any case, just ugly day in Bitcoin and in crypto, and just continuing to be ugly in Bitcoin overall. So I'm going to leave it there. I mostly wanted to spend time going over that data with you and kind of trying to contextualize and think about how, while everyone's going to point to Powell today at Jackson Hole and say, oh, Powell crashed the market because he was too hawkish. I mean, and all Powell is doing is telling you what they've been telling you for all this time. And I actually, if I go to, let me see if I can, trying to remember who said it. Macro Alf, I think, is who it was. But I think he said this earlier. I'm going to try to find this tweet really quick because it stood out. I retweeted it. This is what it comes down to. We will keep at it until we are confident the job is done. Fed pivot, and no, that's not what's going to happen. And what everybody needs to understand at the end of the day is it wasn't because of Powell. It's just Powell saying what he has to because of what the market and what the inflation data is showing him. There is nothing convincing or conclusive in the data that says that inflation is going to continue to come off at the pace that it came off in the July CPI, which was shown to us this month in August. And there's no evidence to suggest that the PCE is going to come down at the rate that would be required to get any sort of pivot at all this year, or even in the first half, particularly of next year, and maybe even not at all in 2023. So Powell is just telling you what he's always been telling you, and that is that they're going to continue to fight inflation, and they're very concerned about it, and they're not going to back off. This is not the same Fed. This is not 2018. This is not the great financial crisis. This is a completely different paradigm, and you have to basically get rid of the playbook from the last 20 years and possibly more. Otherwise, if you continue to analyze things with that paradigm, then you're just going to end up being disappointed. There is a huge range of possible outcomes. This could turn on a dime and head right back up, and we could be in a bull market for all we know. Or this thing could waterfall down, we could make new lows. Or we could just grind down for the next 7 months like we did for the first half of 2022. Anything can happen. What you need to do as an investor and as a trader is you need to position according to the range of probable outcomes, and that range is very wide. So that's all for today. Thank you for watching. Don't forget to hit the like button, to subscribe if you have not, and to share this with somebody who might find it interesting. And with that, I hope you guys have a great weekend. Stay safe out there, and I will see you guys next time.